The Child Millionaire strategy depends on you and is created with your goals, objectives, and budget in mind. To exemplify what we mean, let's use the same scenario as before. You've saved $200 a month for your child or grandchild since birth. By the time they reach the age of 25, their policy will have an estimated value of $75,000. The owner can borrow against that cash value to help pay for education, for example. But here's the exciting part when the money is leveraged. The cash value on the policy remains the same. You are not withdrawing it, and the money continues to compound on that cash value even as you leverage against it. The cash is accessed without applying for traditional loans, where you would need to fill out forms and go through an approval process. The only questions asked are, how much do you want and where do you want it sent? The cash value is collateralized, meaning it's used to secure the amount accessed. Typically, you can borrow up to 90% of the cash value. When the amount is paid back, it's paid back with interest. The policyholder benefits, as we also take on the role of lender, since we are part owners of the account. If the money never gets paid back, the amount borrowed plus simple interest, compounded annually if not paid, is deducted from the death benefit value. Think of it as an advance on the death benefit. We do not recommend this before passive income time because by paying the money back, you put more money back into the system to be used again. There are no penalties or fees to access the cash as with many financial tools. Essentially, it's a loan given by the insurance carrier to the owner, secured by the policy cash value without all the hassles, payback restrictions, or costs of a traditional bank loan. We will explore the power of OPM, other people's money, later, as it's a critical point to understand in this process. Now imagine your child just turned 30 and wants to buy their first home. The same scenario as before, you saved $200 a month, a total of $48,000 on a par whole life insurance policy. The cash value at age 30 would have an estimated value of $98,000. If your child buys a home for $350,000, they will need $70,000 for a 20% down payment. The child could borrow from their whole life policy, no questions asked. Think this is significant? It is, and for more than just the obvious reasons here. Let us tell you a story. In the introduction, we talked about two parents who saved for their children's future from birth and compiled a hefty sum for each. Now 22 and 19, these two boys have funds well into the 6-digit range, even after paying for college. But once again, note that these were not wealthy parents. The eldest child, now a career fireman, bought a home for $349,000. Of course, he had the funds to do so, and at the age of 22, he was a homeowner. Yes, this supports our previous explanation, but here's something else to consider. By no longer renting to a high-dollar area, he reduced his monthly expenses by over $600. Yes, his mortgage, even with taxes, HOA fees, and only the required 20% down, was $600 cheaper than his one-bedroom, 5th-floor apartment. Basically, he traded in a 900-square-foot apartment for a 5-bed, 4-bath home on a golf course in a gated lake community and saved himself $600 a month. Now, the additional $600 a month can be invested to create passive income for his future. Time plus compounding equals the opportunity for greater compounding.